again showing that divergence there between that and manufacturing. So on that front, it's good for them guys. They set the one midpoint at 7.0904, which was just a tiny bit lower than the 0939 last week. So they're keeping it now a few days around that 7.09 level, even while one's still been moving around. We were down below it last week. Last Friday, we came off the top. Where's it all gone? Lost it. There we go. Oh, there. We did get a move back under 709 and off these highs here, but we're right back at them again today. So again, we might be kicking on further from that, but those fixes still coming in around the 7.09 level. So maybe that's trying to put some brakes on it. We'll wait and see. Over to Japan, and the government has drafted an economic policy platform saying the government will eradicate the deflationary mindset, move towards ending deflation with bold monetary policy, flexible fiscal policy and growth strategy. Hopes the BOJ achieves its 2% inflation target sustainably and steadily, accompanied by wage growth. Government and the bank will closely coordinate and flexibly guide policy with an eye on the economy, prices and financial conditions. The government will take steps to achieve a virtuous wage inflation cycle. So Kishida then is cabinet setting out what they want to achieve from that. If they manage it, that's again going to be something for the Bank of Japan to consider in terms of tightening, or at least getting out of the current policy path that they are on. Services PMI from those guys as well, a little bit softer. Oh, where is it? Up there. 55.9, so up on the prior month, but not as high as expected. And just above there, you can see the Aussie number as well for services there. A little bit of a dip there, but not as much as expected. So as we're seeing, again, these services numbers are coming in much better than manufacturing. On that front, I don't think we've got any other data. Nope. So that's that from that one. So coming across to now the SMB and Vice Chairman Schlegel saying we are seeing increasing signs that inflation is spreading to other areas beyond energy and supply bottlenecks, and that inflationary pressure is broadening. Cannot rule out further tightening of monetary policy to ensure price stability, and remains ready to be active in Forex markets. The SMB meeting is the 22nd of June, one of their quarterly meetings. So they seem to be pumping us that perhaps we're going to get another hike. The market has been pricing a 25 pip hike, but I think a 50 is potentially still on the table, given that they only change monetary policy every quarter. So that might be something for Swissy traders to keep an eye on if the market is underpricing a hike from those guys. Over to the ECB, and ECB's McClough says a fall in Eurozone inflation is very welcome, but it's not definitive, and underlying prices are still quite strong. It's likely to see another rate increase at the next meeting. Have not reached the moment where we can say, let's now stop. It says the picture is a lot less clear beyond a probable rate increase in June and July. So touting June and July, and we've got a bit of a question mark over September from a lot of ECB bods. ECB's Wojcik says Eurozone inflation risks are still tilted to the upside. Wage pressures are still very lively. Excuse me. Coming over to Germany, engineering orders were down 14% in the February-April period year on year. Domestic orders were down 14%, and export orders, foreign orders, were down 14% as well. Just in April alone, they were down 20% year on year, with domestic orders down 15%, foreign orders down 23%. So that's highlighting the problems going on in Germany. Looking at some of the other PMIs and other data, as you can see there, imports up sorry, exports up in Germany, 1.2, bit of a surprise change around there, while imports were down 1.7 there. So that should, as you can see there, help the trade balance, which came in at 18.4 billion, higher than expected. So a bit of a surprise there, considering growth has been a bit lacking on that front. May see a bit of a pickup in some of the revised numbers for the GDP that we get through there. Speaking of inflation, in Switzerland actually came in softer, 2.2% year on year versus 2.8 expected and 2.6 prior. So that flips the coin a bit in terms of what the S&B might do with rates on that. So those comments from Schlegel leaning one way, the data leaning the other way. Spain services PMI, we've seen pretty much all the PMIs just coming in a little bit softer this morning. Still decent expansion numbers, but Spain missing expectations there and a fall in last month, was expected to rise. South Africa, for those that watch the rand, coming in worse into contraction. Italy as well, a dip. France, a dip. Germany, a dip. You're getting the picture now. Well, actually, their services went up to 57.2, so maybe a little bit of a pickup coming in there. The Eurozone, main Eurozone number dipping there. UK coming in higher than expected, but another little dip there. So we're getting the message. Later on today, we get the US ISM numbers as well. They're going to be hotly watched as well, particularly the price measures in that after what we saw from the manufacturing numbers last week, but we'll touch on that in a moment. PPI in the Eurozone not rising as much as expected year on year. Was expected to rise 5.9%, but it actually only came in up 1%. So those price pressures waning in the PPI as well. The month-to-month number coming in a touch worse than expected as well, or lower than expected. So further taking some inflationary pressures out of the pipe there. And regarding the ECB, Morgan Stanley now see the ECB ending its hiking cycle in July at 3.75%. That forecast will probably be revised by the time we get to the end of the day. We know what those guys are like forecasting. Coming over to the US, and obviously last week's numbers, another gangbuster from the NFP. And just roll back there. Headline number beating all expectations, 339. Certainly beat my expectation in the compo. I went for minus 153 just because I like to be different, so couldn't have been further away from that one. Wages just ticked down a bit to 4.3%, but no real news in that one. I was looking if there was going to be a big variation there, but it wasn't in the end. So as inflation obviously keeps coming down, the gap between real earnings is closing. So we may see a little bit of a crossover there if inflation comes down, which is the PCE is round there or thereabouts, pretty close at the moment. The surprise was the unemployment rate rising to 3.7%, worse than expected, and that was all the while the participation rate stayed unchanged. There's been lots of talk about why you can see job gains of 339,000 and yet the unemployment rate rising. A lot of people pointing to the differences between how this survey is taken. You've got the household survey, which takes the unemployment rate, and then you've got the business survey, if you like, where firms are asked about what's happening in hiring and stuff. So people are pointing to this disparity between the numbers. And as Michael Brown pointed out, my mate over at Pepperstone, they only tend to pick up on this disparity when the news is bad, not when the news is good. But either way, the Fed, the market, is going to be looking at that number because it's seeing unemployment rising, even with the strong job gains. Overall, I'd call it a pretty neutral number in terms of what it means for the Fed. It doesn't mean they need to be more hawkish. It doesn't mean they need to be less hawkish. The jobs market is still ticking along nicely. Even with the unemployment rate rising, it's not getting up to their levels where they're going to start to be worried about it, or it's higher than their forecasts. So for now, the Fed still has a green tick there. If inflation continues to come down, they get what they want from that side, and they haven't as yet collapsed the jobs market. So it's a win-win at the moment. Stel, what did you make of those numbers last week?
Well, I had a good discussion with a friend of mine about this. You know, the method that their non-farm payrolls is calculated has been the same since 1968, and he was saying that this is something that has to change because the nature of employment has changed. But anyway, bottom line is that employment is still, at least in numbers, looking good, even though JOLTS was not good, even though we're hearing about layoffs. The number of quits is showing, the one that you look at, I think, Ryan, is showing that employment market is deteriorating, but the headline number is still good. Yes, the unemployment rate ticked up, but then again, the participation rate ticked up by 0.1, so you can kind of say some of that is because of that. What I'm going to say is that we are seeing most of the data that has to do with inflation and prices disappointing now to the downside, and the employment numbers still looking robust. So, you know, the Fed has a dual mandate, and I've said it before, I'm going to say it again. The main reason why the Fed has been tightening like crazy was inflation and not employment. Even if payrolls keep going at 200, 250K, if inflation drops down to target, you bet your ass they're going to be stopping their tightening, and they're going to just, you know, sit tight and see what happens. So, yes, strong numbers, but I'm putting a lot more emphasis on price and inflation numbers now. But yeah, you know, a pretty big number when it came out. I mean, the market was definitely liked it, but then again, we saw the reaction. The reaction wasn't pronounced, right?
No.
So anyway, let's see.
Yeah, we obviously covered it on the F.A.C.E show, and the dollar, really popped up for literally seconds and then got sold off. That's what I was expecting to happen, and then it rallied again. So yeah, it's very, very mixed reaction there, and very surprising what happened with that. But yeah, it's good numbers, and yields are back higher, and the market's probably getting back into soft landing territory. But even with that, we're still looking at the probabilities just now. It's 73% chance that rates are unchanged by the Fed, and the balance 27% that they hike by 25 pips. But as Mike says, it's all going to hinge probably on that inflation data the day before the FOMC. And then I still say that might actually be bigger than the FOMC itself in terms of market moves. But we can look at that next week. Okay, did you manage to catch the NFP, or were you?
No, I didn't at the time, but I was a bit surprised in a way to see the unemployment rate tick up. But there may be some lag or so, or differences in which numbers go into that. But yeah, I mean, we have to admit that the employment domino is still standing, right? And the participation rate ticked up just slightly. Well, it's same as last time, but a small tick higher than expected. No, I think, well, to me, it's probably a fair assessment that you have like a 70% chance of standstill, because that I did catch. There's a bit of a side now at the FOMC who say that it's time to pause and see how the transmission goes, but there is still that fair percentage that they could do another hike, despite inflation data starting to coming off. It has been coming off, but and I think the whole curve is the real interest rates are all in positive territory, if I'm not mistaken. But could be that the really short term is or the longer term, I should say, is not there yet. But yeah, inflation adjusted, it should be okay. But yeah, I think it's a fair assumption that there's a fair chance that they still will go for 25, but then they should announce a pause probably for the summer months. So it's a bit of an open question right now. And as you say, the inflation number just right before the FOMC could be the clincher and yeah, be the bigger market mover actually.
Yeah, I think we're going to see that. I mean, you know, you missed this last week. We were pricing the other way last week. We were pricing 60-70% chance of a hike until we got those two speakers, Jefferson and Harker, and then the price components in a lot of the data went the Fed's way. The PMIs, I think it was the S&P Global PMI showed the first drop in prices in 3 years. So they're getting it going their way, and it was quite something to see rate expectations flipping that much. But there we are.
That is again that's again a sign that this market is still fishing for the truth or fishing for what is really going to happen. And we've seen this flip-flop already several times, right? It's quite amazing how fast this market is still repricing expectations. It's really amazing. It really amazes me, to be honest. You have this I'm just looking at it last week, and yeah, you come out of a 3 in the tens, 385 all the way down to 355, and then now we are back at close to 3 3/4. It's those are big moves. I don't know if people really are that active repricing everything all the time, or is it just like algos and the bigger accounts just sitting on the sidelines? But those are still pretty big waves. And I was catching up on the prices, of course, this morning, and yeah, the waves are still there, which is good for us. It gives us volatility. It gives us some nice pictures also, or some nice moves to try and catch them. If you look at the market repricing the interest rates so much, which are still driving the market, it does create decent waves in FX as well.
Yeah, exactly. I think a lot of that move down south in yields was just getting over the debt hump, and some of that premium coming out. But then we're back trading the fundamentals, and we're strong jobs. It's higher for longer is the term, and this potential soft landing that we're back in. But as we know, it can change in a day. We get a crappy ISM later on, and we might be pricing cuts by the end of the day. You never know. Just a couple of other headlines. We had this OPEC stuff over the weekend where they put the press block on everybody. Saudi Arabia decided that they're going to cut production by around about 1 million barrels per day. And so we were looking at a gap upon opening, and a gap we did get, but it wasn't as big as the last one we got back in March, April. Only a couple of bucks really, and that has given up most of it anyway. So they didn't get as much bang for their buck as they were hoping, and it remains to be seen what other countries follow suit with that one. So if you're trading oil, we were musing last night in the chat room about how long this gap would last. It's probably going to last or not last as long as the last one, so that could be closing up pretty quickly. On the geopolitical front, there's on-off talk about whether the Ukraine has started its counter-offensive. Russia may have tried front-running that with a headline via TASS saying that they had. There's been nothing that I've seen over the last few moments to say that they have, but that could mean a bit of an escalation going on over there. Just something to keep an eye on for risk trades.
Ryan, if I may interrupt, I'm really sorry. I actually have to jump, so I will see you guys later, okay?
Yeah, okay, mate. Have a good one.
Welcome back, Kay. Welcome back.
Thanks, Dale. Enjoy the beach, mate.
Thanks, mate.
See you, mate. Yeah, so watch that on the risk front for that one. So how are we looking coming into today? Well, let's have a quick look to see what is coming up this week and today. So we've got the final S&P Global services PMI from the US there, factory orders, and then the big ISM services number there, where we need to watch those price components and maybe employment once more. Tomorrow we've got the RBA, and it's really a bit of a coin flip what happens with those guys, a bit like the Fed. No last minute data to swing things one way or another for that one. So there's about 2/3 of people polled for the RBA decision think they're going to stay on hold, and the other third thinks they're going to hike. But all sides think that there is a hike to come, be it this meeting or not, or one of the following meetings. This is what's happening at the moment with forward guidance or explicit forward guidance being thrown in the bin. You remember when Lagarde gave us 3 hikes on the trot, forward guidance, and then got told off by some of her governing council, and so they moved away from giving explicit forward guidance. Well, the same thing's here. So these rate decisions are going to be a bit of a coin flip. Both the RBA, the Bank of Canada, the Fed, ECB and Bank of England may be clearer cases of the fact that they're likely to hike. So for this one, Kay, you got any expectations for the RBA? Do they hike? Do they pause?
Yeah, I was going to say we are in that period where, and we said it for a while already, that we will become and we've clearly entered that period now. Also with the RBNZ surprising the other week, where central bankers will probably decide themselves on the last minute when they will if they move or not, and specifically looking at what's to come, the RBA, Bank of Canada, and the next week FOMC, ECB. The market will have to react on whatever they decide to do, and as I was saying earlier, with those rate expectations for the 70-30 for the Fed, I think the RBA is exactly the same, and we've seen RBNZ surprise the market, and I reckon RBA could also surprise the market. They could go with a dovish hike, because they did. Was it them who said something about the housing market is set to worsen also? But then we've seen contradictory data out of Australia, which would actually support a hike again. And we are in that period where we will unfortunately have to wait. Everybody will have an opinion, but we will have to wait for exactly what they do. And there could be a bit of surprises here and there with any of those central banks, because we've seen the Bank of Canada, who were clearly on the pause, but then the data coming out over there, especially the employment data, are still pretty strong, and they may be forced to do another hike because there's not so much stress in the system yet, and they still have a window, because that window could at some stage start to close. We've seen the inflation data coming off, but so far we've seen PMIs coming off as well, but in the manufacturing sector, we could argue that the European manufacturing sector is doing pretty badly right now, but then the services are holding it up, and we are going to be also on the data front in a period where we will have to react to data rather than put too much of expectations in one way or the other. So in 2 words, yes, they could surprise. They could do anything really, the RBA overnight.
Yeah. So when you're talking about trading and stuff, are we in that period? I can't see the RBA doing anything unless they're gonna tout, unless they hike and tout 2 more hikes ahead. I can't see any reason why any moves higher in Aussie dollar lasts, particularly over these announcements. I think they might present short-term opportunities to maybe nick a counter trade if we hit a decent level and can't get through. Up at 68, for example, in Aussie dollar. If you get up there on something hawkish, that's a potentially bit of a stretch point, because we are only talking small clips now in hikes. And a hike shouldn't be giving anyone 200 pips, 300 pips in moves. So do you think we're in a situation where we can perhaps in the short term counter some of these central bank moves?
I think there's a real possibility. Look at the last hikes we had. What happened in the day, the 24 hours after, we had well, the Kiwi was a prime example, but the Aussie has also had serious counter trades in the 24 hours after the central bank. So we are in this area where a central bank may do something, but unless it's a big hike and they are very strong in continuing to signal hikes, the moves may be actually relatively juicy counter trades, and then you will have to look if you want to do it. Sorry, if you want to do it versus the dollar. I still think that despite, and I've been trying to catch up on all those data that I missed over the past 10 days, but I still think the dollar looks pretty okay right now. We had this end of month shenanigans as well, and then helped by the Fed members probably signaling a skip, as they call it themselves. But yeah, if you look at it, the U.S. yields are still pretty high. If when the dust settles after the RBA or Bank of Canada, and U.S. yields don't have too much reason to come off after that, then it may be a counter trade if you get a blip higher in the Aussie. You'll have a look, or I will have a look at the Aussie in a minute. Really.
Yeah.
I'm just trying to while you're showing your stuff, looking at the levels in the Aussie. I think anywhere around, where is it, 66.60 again is a bit of a crossroad on the Aussie dollar, perhaps.
Yeah.
So that's about 1% from where we are now, which is a reasonable move that we could expect. Yeah, you have your blue zone there. It's around there, right? And then above there is that 67 red line. Yeah, may really be a decent area if you get the blip to try and counter trade it. I don't know yet. I probably won't be up, but it looks all right, because none of the central bank moves have been really directional for longer than the actual reactional move, right?
Yeah.
So.
Yeah. Exactly. Okay, so let's have a look at what else we've got going on. So we've got the RBA, some smaller data from Germany, manufacturing orders, Eurozone retail sales, which don't often have a big impact, but it gives us an idea on the Eurozone Eurozone consumer in general. Italy retail sales on Wednesday, then obviously the BOC. And I think, again, we're in a situation, we know these guys are on pause, but I've been getting a bit of a twitch that they might be looking to turn a bit more hawkish. The data has been leaning that way. Obviously got those GDP numbers, stronger GDP numbers the other day, which got the market thinking they might be going a bit hawkish as well. I expected to keep rates unchanged at that meeting, but I think this one might be another coin flip. You got any thoughts on the Bank of Canada, mate?
Yeah, exactly as I was saying earlier, and you said right now, it's a total coin flip over there, because they were so firmly into pause mode, and but the data are telling them that they can continue. Let me just quickly, where are they now? 4.5?
Let me tell you, they are at 4.5. And probability actually pricing 74% chance of a 25 pip hike.
There you go. Yeah, but also being very close to the US, they can actually use some sort of excuse to still stay behind, but do that quarter, and then go back into pause mode. I think McClem is definitely a guy who would like to pause. He said as much, because he does really point out at risks quite often when he does his meetings. And yeah, so we may be in for a bit of a dovish hike perhaps on that one. I saw some levels, some really decent levels in the 133s, I think, on the dollar Canada, which could be a good area. Yeah, it's low 133s there, around 133 figure 15 or so. That could be a decent area if we get a hike and move on the back of it, depending on how they bring it over. But again, yeah, we are in that period where unfortunately anything can happen, and it's a bit tough to predict exactly what they are going to do, because I reckon they don't know themselves before they actually take the decision.
Yeah, exactly. And yeah, this one's been playing nicely.
Yeah, look
had another hit off that 36.50 all the way down. You know, when we were up here last week, I thought we might begin to push up, maybe test the highs, 138, that big area up there. And we got a similar one down here into the 133s. So that's looking very good down there. A good potential stretch point down there if they are a bit hawkish without hiking.
Yeah, the 133, that figure 15 is a really good zone, because I think if it really breaks and it holds below, then you're on your way to 130.
Yeah, no, I could agree with that. I think there's I don't know, it's got a bit of work to do. You know, we've had prior resistance, prior support down in the mid 132s, and then we've had that right down into the low 132s from 25.30 down to the big figure. That's going to be a big gold area, I think. If we get a break under there. So yeah, and it's well within target, only 150, 200 pips away, and that's well within range for the loonie if it's one.
And we do have the Canadian jobs report as well this week, or
we've got the jobs report. Yeah, I think it's double. I think we get a monetary policy report with this one, so we get Macklem speaking, I think. If not, they usually pop up the day after in one way, shape or form. But yeah, Friday it's the CAD jobs, so that could be a complete flip around to whatever happens at the BOC.
Could be very hot for the Canadian dollar the second part of the week.
Yeah, definitely.
Yeah.
And
Can I ask you a question now, Ryan, before the audience does? I want to ask you about the sterling, because it's been a real whipsaw since I've gone, and I know that overall, as kind of expected, as I was expecting anyway, the sterling would be doing better than the euro, so euro sterling is lower. But what about? Do you think there's a lot of end of month stuff that happened there last week, because there was this move down to the low 123s, then the jump up to all the way back into the 125s in the cable, and then now we're back below 124. What's going on in sterling these days?
Yeah, I think particularly in cable, I think a lot of that was the debt ceiling stuff washing out, and then coming back to the fundamentals. So you know what cable's like, it flips around. But I think that the real story is that the market has really been ramping up expectations for the Bank of England, and I think that's behind this breakdown. I think down here, I'm not sure we get another push through here. I'm not sure we're done with the downside just yet. But I'm thinking that down around, if we get low 85s, that's going to be an extreme area for pricing, particularly the Bank of England. But yeah, there's been a general uplift in what the market views are happening in the UK. A few weeks ago,
then we saw
fire and brimstone, and now it's all reversed again.
Yeah, because I got that move that the sterling was doing better than the euro, for instance, because we spoke about that, and I always said the sterling seems to have more elasticity than the euro. Yeah. But then it can't hold the lows either in the euro sterling, so there must be some. And then we had this fallout in sterling over the past one session. Let's put it that way. Where it looks a bit weaker again, but then when I look at the data, I don't really find a reason for sterling to materially weaken either right now. So it's a bit,
on that. Yeah, on the euro sterling, I think it's definitely central bank divergence. It's a definite uplift in BOE rate expectations hitting it there. But against the dollar, I mean, like you say, cable's been up and down all over the place throughout that. It had, but it's holding where it needs to hold. Do you know what I mean? It's playing nicely between the levels. You know, we had the test down towards the end of the month, down towards the 123s, held that. And we had our old mate 124.50. I've been saying, I said on the flow show pretty much all last week, cable, you just play the big figures and the half figures at the moment, because that's what it's doing. I mean,
we're still jumping around, and we're still jumping around the magic 124.40.50 in the end. You trade a big figure below, and then it flies through, and then and somewhere, if you look at those little pauses where it stops, then it's again around 124.5. I don't know. I still think there's a case for sterling to hold somewhere, but perhaps not immediately now. I don't know.
No, but this is what, 350 pips top to bottom. You know, that's pretty tight for cable. But you know, it's when it's having its moves, when it runs into trouble, you can pretty much be certain where it's likely to run into trouble. And to say, for the moment, it's the half figures, it's the big figures. You don't really need to be messing around in between them. Just let it do its thing and see what it wants. You know, it's going to have to break 123 for further downside. It's going to have to break up above 126 and these prior highs for upside. So, as we like to say, mate, go with the flow. Have you got any charts you want to have a look at, or are you still redrawing?
I'm still catching up, but I can show a couple that just spring out.
Stuck out. Let me hand it over. 1 second. All yours.
Yeah, and perhaps I'll show it on a little wider also time frames. But there's this one here, this dollar yen. I drew this this little channel, and so around mid-May, sorry, we broke above. Retest, then dollar yen went into the 140s while I was off, and then we had this again 1st of June when the dollar got hammered on the expectations of a skip in hikes, and look what happened. We retested the trend line and bounced from it again. So I think this trend line here, well, a channel, the top end of it is starting to get quite interesting. Before we can even talk about this 137.5, we should call it, and 138 the figure. So I think this one that really jumped out to me is a quite interesting one, quite interesting hold on the dollar yen, but it's on the daily, right? On the euro, also the bounce and the bounce. Yeah, have it. Yeah, I had this double line here and a bit of a trend line around 108, and the bounce stopped just shy of 108 the other day, and then we started to come off. So for the more medium term, I think your 108 is starting to show up again here. For the short term, I'm not too sure, because it did easily go back above here, the 107 25 or 30.37, I think it is somewhere. That may be your first area in the short term that one needs to watch. But it's a bit in the middle of nowhere that it stopped the other day. We can say that it stopped shy of 108, but it did stop already at 107.80. Perhaps there's a bit of a, I don't know, is there a bit of a retracement here? Nah, not even. So, but I'd say the 108, keep an eye on that one. And then on the bottom side door, on the other hand, this rally that we saw here from March all the way up into April, the 78.6 is at 106.40, and that's where we stopped rod on the way down. So 106.40 I think is your area to monitor on the downside. So you have like 160 points here, 170 points of a range to observe. Would you agree when I say that the ECB members, Lagarde, on Lagarde leading the pack, saying that they're still on 4 hikes? She came over still a bit hawkish last week.
Yeah, we're pretty much, June's done hike. July is probably, I would say, 80% likely to be a hike. I think we're arguing now or discussing now whether we get one in September or not.
Okay. The cable, this is a bit of the inverse channel. It looks like that I saw in Dorian also, meaning that we tested it and then came back off. I've only drawn this morning, so that's not something that I was looking at before. It stopped around here, but now this morning I see that we stopped right up there and up here as well. So this 125.5, 40.50 is a pretty decent zone on the way up, and then on the way down 123 the figure. And this one I've been watching for quite a while already, and that's your 122.60.70. I think if cable ever goes down below there, then that means bad news, I think, for the cable. Yeah, euro sterling, Ryan already showed it. I'm not so sure what to think about it. We could be just in the more medium-term process of trying to forge a range here with the mid 85s being the bottom, but we did break this trend line around 86.15, but then we're already back above. I'm a little bit scratching my head in the euro sterling, but it could be that around this 85, 40, 50, that's enough. That's enough for now, especially if ECB continues to hike. But if you look at pure data, I still say that somewhere, if I want to be long either of them, perhaps the sterling could be the better one, but you have to wait for retest. So for instance, here, if you see a retest of the 86.65 zone, that's going to be an interesting one, I reckon. If you look at it, if by then data don't show weakness for the sterling, then that may be a decent area to reflect on a position also. But for the time being, I'm going to let that develop like most things. Yeah, before my holiday, and I didn't update. I didn't update it yet. But I was short. I was at that short dollar Norway in this zone here, and that got kicked out. That on that spike here up above this zone, had my stop, and that just went out of the window.
Don't talk to us about the knocky, mate. We had all that last week.
Sorry, mate.
We had all that last week with the euro knock. A few of us tried hitting that one up at the 1190s in euro knock.
I saw the Norges Bank is still continuing selling pretty decent Norwegian kroner every day. So it's 1.3 billion NOK. So we saw this retracement. I guess it's on the back of oil and on the back of the expectations for the OPEC. Yeah, I mean the Norwegian kroner, and as I said, I still haven't updated this one here, the euro NOK, but it's still trading around lofty levels. I'm not sure whether we have seen the top here. Well, I think we may have seen the top, but is it ready to go a lot lower? I'm not sure. I need to have a closer look at that. Yeah, so Ryan was already showing this dotted cat. This is a decent one in my opinion. A very decent zone here. This 133 figure 20. That's the one I'm going to keep an eye on over the Bank of Canada and the Canadian labor report. We could have a massive saloon door in the Canadian dollar second part of this week, or we could have a double push either side if they decide to remain on hold and dovish, and finally we would get a bit of a give back on the labor report. If you start to close above 135.15 here, then we could easily get back up into the 136s on the dollar Canada. If in turn we get a hike and the job market holds up, why not see pressure build on this 133? And then, as Ryan said, you have those 132s. But if that would go, then I think there's a pretty big gap here below that could be traded. It could, if both come out positive for the Canadian dollar. And yeah,
EuroCAD's looking interesting as well.
Sorry?
EuroCAD's looking interesting as well.
EuroCAD, absolutely. If you look at this magic, this is really a magic zone, right? Well, you have to allow for algo pips, as I call them. But this 146.5 is really your magic zone again, and
we got that double bottom down at the one. Got that double bottom down at the 142.50s, 40s, which could be like
as well.
Yeah, could be 133 dollar.
And already a zone of interest not far from where we are, around 43.30, 40 to 25.40, call it. That's already an interesting zone as well, but it does look, if you look at this, it does look that we are on our way back to this double bottom, and then we either consolidate this, and then you have your initial 400-point range here, or there's something going on with the euro, that the euro picks up strength, and then you can go all the way back up if it breaks. Here, but it's very interesting, this Euro Canada indeed, and I'm going to have a much closer look at it if ever we find the edges of those ranges or moves. Yeah, very interesting indeed. Yeah, dollar rands. I did, while I was out, I got done on a take profit here. Yeah, that was around here. That was right after I left. I got done on the partial take profit. Then it was like hesitant. I missed this move, so I decided to lob a little bit more out once we were just below 1970. So I've only got like a small piece left. I had a trailer just below here at 1937, but then looking at this one where there's another one at 1935, I decided to press it down a little bit. I'm going to have a look at what's happening in this zone. If we start to go back above 1940, I may actually add a bit again and see if we can retest higher. But the overall move is still strong, right? I reckon, well, 1880, but then already we were holding around the 1895 figure. Your 19 may be the new 18 that we saw here. So I still think, and the data don't support a stronger rand somewhere either. So maybe some positioning, maybe some expectations as well into the Fed next week. Could see a straight back down here, but anyway, I'm still negatively oriented towards the rand, and I'm a tad surprised somewhere that we had this 3% move back down because of this one. Dollar China, which is just continues to press higher. Yeah, Ryan already spoke about it. Are you still long, Ryan, or?
No, I ran out of slices. My last one was off at 712. Been waiting for a dip, so yeah, dip down to that 702, 703 area.
Yeah, this one. Yeah, I've let mine go a bit too early in this zone as well. I just didn't want to have much on over my holidays, so. But it's a full percent higher, or nearly a percent higher. It's a strong move still. It's going to take some doing to break back this whole zone here, which is about a 1% wide, 697, 702. It's gonna take some doing to break back below, I think.
Yeah, I think I might have to set sights a bit higher around about that 704.05 area, maybe even. But yeah, we haven't had. We've had a few comments, a couple of comments out, like officials in China were asking around firms to see what how the yuan weakness was affecting them at exports and imports and stuff like that. So they are sending out a few small submarines, but nothing explicit still yet.
700. If you take if you take this triangle 700 and you add it here, that would give us very close to those. No, it's about 30, so that's about 730 around here. If you, yeah, I don't know. I mean, there's probably a lot of geopolitics as well at play, right?
Yeah.
Okay. Yeah, the other one that I completely missed. I did put an order in here for my holidays in case we would go and test the channel. But it stopped in the 1930s, this Euromex, and now we are already back to fresh lows for this move, and it's still looking very, very, very well oriented to the downside. Got a bit of support here in the low 1870s, and we are very close. So if that would break, then you're probably already trying to for the next leg lower. And it's still a very, very, very good carry trade. There's a bit of nervosity going on in Mexico right now around the silver mining and the silver mining companies, because Lopez Obrador wants to have a bigger say in all those mining contracts and stuff, and we need to keep an eye on that one. But for the time being, the market is completely ignoring any of those risks for the Mexican peso. The Mex is still of the best currencies out there, and I'll keep it to that for today, Ryan.
Yeah, thank you very much, mate. Welcome back again.
Sure.
Yeah, so not much else to cover. Hope we've got you set up for the week ahead and what's to come, what to look at, what to trade. Thank you very much, Kay, and I'll say thanks to Still if I can raise him on the beach. Hope you have a great week's trading, guys and girls. You won't see me for the rest of the week, unfortunately, because I'm off to Prague tomorrow, early doors. So I'll be leaving you in the capable hands of Kay and Stell. I'll see if I can pop in between pub runs, perhaps. Other than that, have a great week, everybody, and we shall see you all tomorrow.
And go Hammers.